Breaking news: auto lenders are tightening their belts, repossession rates are spiking, and car prices are plummeting. Is this the bubble bursting? And more importantly, what does this mean for your wallet? The answers and the strategies you need are just ahead. The car market is going through a seismic shift, and it's impossible to ignore the warning signs. Week by week, repossession numbers are climbing, leaving lenders with mountains of inventory they can't move fast enough. Rising interest rates are only making things worse, forcing monthly payments higher than ever before. Meanwhile, used car values are sinking after years of inflated prices, putting tens of thousands of Americans upside down on their loans. The question is, why is it all happening? And what's coming next? Experts are pointing to a perfect storm of economic conditions. During the pandemic, we saw a massive surge in used car demand as new car production sputtered under supply chain disruptions. Prices skyrocketed, with some vehicles selling for 30% or even 40% above their pre-pandemic value. But what goes up must come down. As supply chains normalize and new cars become plentiful again, used cars are losing their inflated worth, and fast. Strong demand has flipped to an oversupply problem, causing dealerships and private sellers alike to slash prices to compete. This correction is already catching many owners off guard, especially those who financed heavily during the boom. Repossession data offers another troubling glimpse into the car market's fragility. According to a September 2023 report, the rate of vehicle repossessions has surged 40% year over year across subprime borrowers. While repossession spikes often start in subprime loans, the trend isn't staying confined there. Prime borrowers who once had near-perfect credit are also struggling at unprecedented rates. Some analysts are even comparing current repo numbers to those seen in 2007, right before the Great Recession peaked. Back then, the soaring repossession rates weren't just isolated to cars. They were the canary in the coal mine for a much larger economic downturn. Could history be repeating itself? And it's not just repossessions we should be concerned about. Auto loan delinquencies are reaching new highs, a key signal of consumer financial health. The New York Federal Reserve recently published data showing that loans at least 90 days past due are now at their highest level in over a decade. Combine this with average monthly car payments breaking records, hovering near $750, and it's clear that millions are stretched to their financial limits. Rising interest rates have played a significant role here. With the Federal Reserve raising rates sharply over the past 2 years, borrowers locking in loans today are accepting APRs that are double or even triple what they might have been just a few years ago. For many, maintaining those payments alongside mortgage or rent, utilities, groceries, and other costs has become an untenable balancing act. What's even more worrying is the way tightening credit conditions could cause a ripple effect throughout the entire economy. Auto lenders are responding to the wave of delinquencies and repos by pulling back, making it harder than ever to qualify for a loan, particularly for lower-income borrowers. Those who do qualify are being pushed toward much shorter loan terms and sky-high down payments as lenders seek to mitigate their risk. This is shrinking the pool of potential buyers at the same time that dealerships are dealing with a flood of unsold inventory. And the result? More vehicles sitting on the lots, losing value by the day. But here's where it gets even scarier. If the car market crashes, the consequences won't be limited to just vehicles. Autos represent the second largest debt category for American households, right behind mortgages. A meltdown here could spell trouble far beyond the used car lot. It could ripple into broader credit markets, reducing consumer confidence and spending. It's the kind of domino effect that historically precedes recessions, and economists are divided over whether 2025 will mark the start of a full-blown economic downturn or just a painful correction. Either way, expecting things to return to normal might be wishful thinking. So, how much have prices actually fallen? According to industry data, the average used vehicle price has already dropped by close to 10% compared to its pandemic peak. That may not sound earth-shattering, but remember that this correction is still in its early stages. Some segments, like high-mileage sedans and compact cars, are seeing steeper declines, upwards of 15% to 20%, as demand shifts toward SUVs and trucks. Meanwhile, experts suggest prices could continue sliding well into next year, depending on how the inventory surplus plays out. For consumers, this could mean incredible deals down the road if you're prepared to wait. Here's the thing though, while falling prices might seem like good news, they come at a personal cost for many. Take someone who bought a used car in 2021 for $30,000, only to discover it's worth $25,000 or less today. If they finance that purchase, they could now owe more on the loan than the vehicle is worth. Being underwater like this significantly limits their options. They can't sell without eating a loss, and trading the car in might require extra cash out of pocket just to settle the loan. For thousands of Americans, the dream of car ownership is now a financial trap. So, what can you do to navigate and even capitalize on a collapsing car market? The answer starts with one thing: being proactive. The longer you wait to act, the more likely you'll find yourself in a tougher financial position. Falling car prices are great if you're buying, but they're far less exciting if they leave you underwater on a loan or struggling to find financing with rising interest rates. And since no one can predict exactly how fast or how far prices will drop, sitting back and hoping for the best isn't a strategy, it's a risk. The current car market presents a huge dilemma for anyone thinking about buying. Do you hold off and wait for prices to hit rock bottom, or do you buy now, fearing that the inventory might dry up or interest rates might climb even higher? Both approaches come with risks, and what works for one person might not work for another. It's less about guessing market conditions perfectly and more about putting yourself in the best possible position no matter how things unfold. For those already financing a car, one of the smartest steps you can take is to focus on reducing your loan balance. With used car values on a downward trend, there's a growing risk of becoming upside down, where you owe more on your car than it's worth. Paying down the principal can close that gap and give you more flexibility in the event you need to sell, trade, or refinance your vehicle. Even an extra $100 a month toward your loan could make a big difference in keeping your finances stable as the market shifts. To show what's possible during a market crash, let's look at a real-world example from the last major downturn. During the 2008 to 2009 recession, used car prices fell sharply, and buyers who were ready to pounce found incredible deals. One buyer reported purchasing a 2-year-old mid-size SUV for 45% below its original MSRP at auction, with only minimal repairs needed. Stories like these remind us that while a market crash creates hardship for some, it opens doors for others who are prepared. Are you ready to be one of them? The car market crash of 2025 is shaping up to be a turning point. For many, it could mean financial strain, with falling vehicle values and rising interest rates creating a storm of problems. But for others, those who act now, it's an opportunity. Start by reviewing your car loan to ensure you won't end up owing more than your vehicle is worth. Consider delaying purchases or saving for cash deals when prices stabilize. As Zach Shefska puts it, car prices are going to crash in 2025. A volatile market always carries risk, but preparation turns risk into your greatest advantage.